If you observe carefully what's happening in the bond market right now, you'll notice something that should deeply concern anyone who considers Treasury bonds their safe haven. The very asset that generations of Americans have trusted as the foundation of financial safety is transforming into something entirely different. We're witnessing the largest holders of U.S. Treasury bonds, foreign central banks, pension funds, and institutional investors, systematically reducing their positions at a pace we haven't seen since the 1970s. China has reduced its Treasury holdings by $300 billion over the past 3 years. Japan, traditionally our largest foreign creditor, is selling rather than buying for the first time in decades. This isn't random market noise. This is a coordinated recognition of a fundamental shift in risk. If you're approaching retirement or already retired with a significant portion of your wealth in Treasury bonds or bond funds, what I'm about to share could mean the difference between financial security and devastating losses. The promise I make to you is simple. By the end of this discussion, you'll understand exactly why the traditional safety of Treasury bonds has evaporated, and more importantly, what you can do about it. This isn't a prediction. It's a logical consequence of the mechanics already in motion. I've spent over 40 years studying debt cycles, currency devaluations, and the inevitable pressures that build when governments accumulate unsustainable obligations. When you understand incentives, you understand behavior. And right now, the incentives facing the U.S. government are crystal clear. They must devalue the debt they cannot repay. The numbers tell an unambiguous story. U.S. federal debt now exceeds $36 trillion, representing approximately 124% of GDP. Annual interest payments on this debt have surpassed $1 trillion for the first time in history, exceeding what we spend on national defense. The Congressional Budget Office projects deficits of $2 trillion annually for the foreseeable future, even under optimistic growth scenarios. These aren't abstract figures debated in economics journals. These are the concrete realities that determine what happens to your purchasing power, your retirement income, and the real value of assets you believe are safe. To understand what's happening with Treasury bonds, you need to understand a simple but critical mechanism that most Americans never learned in school. When a government accumulates more debt than it can reasonably service through taxation and economic growth, it faces only 3 options: default outright, which destroys credibility; implement painful austerity, which politicians avoid because it costs them elections; or devalue the currency through inflation, which reduces the real burden of debt while maintaining the illusion of payment. The United States, like every major debtor nation before it, will choose the third path. Think of it like a seesaw. On one side sits the real value of government bonds. On the other sits the money supply and inflation. When government needs to reduce its debt burden, it doesn't announce, "We're cutting the value of your bonds by 30%. Instead, it creates more dollars, pushes inflation higher, and watches as the purchasing power of each bond payment erodes. You still receive your $1,000 bond payment, but that $1,000 now buys what $700 used to buy. The nominal promise is kept. The real promise is broken. Right now, 4 massive pressures are converging on Treasury bonds simultaneously. First, the Federal Reserve's balance sheet remains bloated at $2 trillion, more than 7 times its pre-2008 crisis level, creating a permanent monetary expansion that dilutes every existing dollar. Second, the Social Security and Medicare trust funds are projected to be depleted by 2033 and 2031, respectively, requiring either massive benefit cuts that are politically impossible or unprecedented spending increases funded by debt. Third, the global de-dollarization movement is accelerating as countries like China, Russia, India, and Brazil establish alternative payment systems and reduce dollar reserve holdings, diminishing demand for the very Treasury bonds that finance our deficits. Fourth, domestic political polarization makes any serious fiscal reform impossible, guaranteeing that deficits will continue expanding regardless of which party controls government. History is an excellent teacher, and the pattern we're seeing has played out repeatedly across centuries and continents. In 1971, President Nixon faced a similar dilemma when foreign governments, particularly France, began demanding gold in exchange for their dollar holdings. The U.S. had printed far more dollars than it had gold to back them. Nixon's solution was to close the gold window, effectively defaulting on the dollar's gold backing. Within a decade, the dollar lost over 50% of its purchasing power. Americans who held long-term government bonds during the 1970s experienced devastating real losses, even as they received every promised interest payment. A 30-year Treasury bond purchased in 1970 paid its full face value in 2000, but the purchasing power of that payment had been cut in half. The Weimar Germany hyperinflation of 1921-1923 provides an extreme but instructive example. The German government faced massive war reparations it couldn't pay through taxation. It chose to print money. Germans who held government bonds believing they were the safest possible asset watched helplessly as their savings evaporated. A bond worth enough to buy a house in 1921 couldn't buy a loaf of bread by 1923. While I'm not predicting Weimar-level hyperinflation in America, the mechanism is identical. Governments with unpayable debts always choose inflation over default. Even more relevant is what happened to Japanese government bondholders after decades of mounting debt. Japan's government debt reached 260% of GDP, the highest in the developed world. For years, economists predicted a bond market crisis that never came. Why? Because the Bank of Japan purchased the bonds directly, creating yen to do so. Japanese savers who believed government bonds were perfectly safe maintained that nominal safety, but watched as their purchasing power stagnated for 3 decades. The lost decades in Japan weren't about bond defaults. They were about the steady erosion of real wealth for those who held what they thought were the safest assets. The 2008 financial crisis offers another crucial lesson. When the global financial system nearly collapsed, the Federal Reserve and Treasury Department responded with unprecedented monetary expansion. They purchased $4.5 trillion in bonds and mortgage-backed securities, creating new money to do so. Investors who moved into Treasury bonds for safety during the crisis preserved their nominal capital, but completely missed the 400% stock market rally that followed. More importantly, they lost purchasing power as the newly created dollars fueled asset price inflation. A retiree with $500,000 in Treasury bonds in 2008 still has roughly $500,000 today, but that sum now buys significantly less, while the cost of healthcare, housing, and basic necessities has soared. To understand Treasury bonds in 2026, you need to understand 3 fundamental principles that govern all debt cycles. The first principle is that all fiat currencies eventually lose purchasing power because governments always choose inflation over austerity. There has never been a fiat currency in human history that maintained its value over the long term. The US dollar has lost 98% of its purchasing power since the Federal Reserve was created in 1913. This isn't a failure of policy. It's the inherent nature of unrestricted currency creation. When a government can print money to solve problems, it will, because the alternative, cutting spending or raising taxes, creates immediate political pain while inflation creates delayed pain that's harder to attribute to specific policies. The second principle is that the nominal safety of government bonds becomes real danger when debt levels exceed the capacity for repayment through growth. Think of it like a restaurant that takes on debt to expand. If the expansion generates enough new revenue, the debt is productive and manageable. But if the restaurant keeps borrowing while customer traffic declines, eventually the debt burden becomes crushing. The restaurant has 2 choices: declare bankruptcy or convince creditors to accept payment in increasingly worthless coupons. The US government is the restaurant with declining revenue relative to its obligations, and Treasury bondholders are the creditors who will receive payment in devalued coupons. The third principle is that protection from currency debasement requires assets that cannot be arbitrarily created. Throughout history, when governments debase their currencies, wealth flows into assets with inherent scarcity: gold, silver, productive land, real businesses, commodities. These assets maintain or increase their value in nominal currency terms because their supply is limited while currency supply expands. A government can print unlimited bonds and dollars, but it cannot print oil fields, farmland, or gold deposits. This fundamental scarcity provides protection that government promises cannot. Let me tell you a story about 2 families I know who faced nearly identical circumstances in 2006, just before the last major financial crisis. Both families were in their early 60s. Both had accumulated approximately $800,000 in retirement savings through decades of careful work and saving. The Johnsons believed in traditional financial advice. They held 60% in Treasury bonds and bond funds, 30% in large-cap stock index funds, and 10% in cash. This felt safe, conservative, and prudent. The Martinezes consulted with an advisor who understood debt cycles and monetary history. They held 25% in physical gold and silver, 30% in commodity-producing stocks and energy companies, 25% in international stocks outside the dollar system, 15% in real estate through REITs, and only 5% in short-term Treasury bills for immediate liquidity. Both families weathered the 2008 crisis without panic. The Johnsons watched their portfolio drop to $650,000 during the worst of it, but felt vindicated when it recovered to $850,000 by 2010. The Martinezes saw more volatility but ended 2010 at approximately $900,000. The difference came in what happened next. From 2010 to 2024, the Johnsons' conservative bond-heavy portfolio grew to approximately $1,150,000. They felt successful. They had grown their wealth by over 40% from the pre-crisis peak. But when they calculated their real purchasing power, accounting for the actual cost increases in their lives, healthcare premiums up 140%, property taxes up 80%, food costs up 75%, home maintenance up 90%, their $1,150,000 bought less than their original $800,000 had in 2006. The Martinezes, holding assets that benefited from currency debasement rather than suffering from it, saw their portfolio grow to $2,400,000 by 2024. Gold increased from $600 to $2,650 per ounce. Energy stocks and commodities surged as inflation materialized. International holdings in emerging markets provided both growth and dollar hedge benefits. Most importantly, their purchasing power increased substantially. They could afford the same lifestyle upgrades they had planned for in 2006, plus additional travel and family support they hadn't originally anticipated. This isn't made up. It's the typical pattern we see when some investors understand monetary mechanics, while others cling to outdated notions of safety. Now let's translate this to what really matters, how this affects you. If you're 55 years old with $600,000 in retirement savings, and you're holding 50% in Treasury bonds or bond funds because you believe it's the safe approach as you near retirement, you're actually taking the most dangerous position available. Here's what a plausible scenario looks like over the next 5 to 7 years. The U.S. continues running $2 trillion annual deficits. The Federal Reserve eventually returns to quantitative easing to manage interest costs and prevent a bond market disruption. Inflation, currently claimed to be around 3%, accelerates to 6 to 8% annually as measured by official CPI. But your actual expenses increase by 10 to 12% annually because the CPI understates housing, healthcare, and food cost increases that hit retirees hardest. Your $300,000 in Treasury bonds and bond funds yields perhaps 4 to 5% annually, giving you $12,000 to $15,000 in annual income. But if real inflation in your expenses runs 10% annually, you're losing 5 to 6% of purchasing power each year. Over 7 years, your $300,000 in bonds maintains its nominal value, but loses approximately 35% of its real purchasing power. What could buy $300,000 worth of goods and services today buys only $195,000 worth in 7 years. Meanwhile, your annual expenses have nearly doubled from perhaps $60,000 to $110,000. The mathematical reality is stark. Your safe bonds are creating a systematic erosion of your standard of living. Let me make this even more concrete with actual daily impacts. If you currently spend $500 monthly on groceries, 10% annual inflation means that same basket costs $970 monthly in 7 years. Your $1,200 monthly healthcare costs become $2,330. Your $2,000 monthly budget for housing, utilities, and basic services becomes $3,900. Your total monthly expenses grow from $5,000 to $9,700. If your bond income provides $1,250 monthly, $15,000 annually, the gap between your income and expenses explodes from manageable to devastating. You're forced to sell principal, but you're selling at exactly the wrong time, when the purchasing power of each dollar you withdraw has already eroded significantly. Based on these principles, here are practical guidelines that make sense regardless of your specific situation. First, recognize that nominal safety is not real safety. The goal isn't to preserve the number of dollars you have. The goal is to preserve and grow purchasing power, the amount of goods and services your wealth can command. Second, reduce Treasury bond exposure dramatically, particularly long-term bonds. If you currently hold 50% in bonds, consider reducing to no more than 10%, held only in short-term Treasury bills for necessary liquidity. This isn't about getting zero return from bonds. It's about avoiding the real losses they'll generate. Third, allocate to assets that benefit from or protect against currency debasement. A reasonable allocation for someone in or approaching retirement might look like this: 30% in precious metals, primarily physical gold and silver, with perhaps 25% in gold and 5% in silver. This provides direct protection against dollar devaluation. 25% in commodity producers and energy companies that increase their nominal prices as dollars lose value. 20% in international stocks, particularly in countries with stronger fiscal positions, lower debt burdens, and commodity wealth. 15% in real estate exposure through quality REITs that own tangible, productive assets and can raise rents with inflation. 10% in short-term Treasury bills or money market funds for liquidity needs and opportunistic deployment. Fourth, implement this transition gradually over 6 to 12 months. Don't panic and shift everything overnight, which could trigger taxes and force you to buy protective assets after they've already risen. Instead, create a monthly rebalancing plan. Each month, move 8 to 10% of your bond holdings into protective assets, allowing you to average into these positions. Fifth, prepare yourself psychologically for volatility. Assets that protect purchasing power fluctuate more in price than bonds do. Gold might rise 30% one year and fall 15% the next. Energy stocks might double in 3 years, then decline 25% in a correction. This volatility is the price of protection. Accept it rather than fleeing from it. Sixth, avoid the most common pitfall: waiting for confirmation. By the time bond losses become obvious to everyone, protective assets will have already appreciated substantially. The protection you can buy today for $2,600 per ounce of gold might cost $4,500 per ounce once bond market stress becomes undeniable. Seventh, don't confuse this with speculation or gambling. You're not trying to get rich quick. You're trying to maintain the purchasing power you've spent decades accumulating. There's a profound difference between speculation, which is taking risk in pursuit of gain, and protection, which is recognizing where the actual risk lies and repositioning to avoid it. Nothing in this constitutes specific financial advice. Each person has different circumstances, time horizons, tax situations, income needs, and risk tolerances. What makes sense for a 55-year-old couple with $600,000 might differ from what makes sense for a 75-year-old widow with $300,000 or a 45-year-old professional with $1,200,000. Consult qualified professionals who understand monetary history and debt cycles, not just those who follow conventional allocation models designed for a world that no longer exists. The choice is yours. But remember what's actually happening behind the scenes while Americans debate whether bonds are yielding 4% or 5%. The Swiss National Bank has allocated 7% of its reserves to gold, up from nearly zero a decade ago. Central banks globally added over 1,000 tons of gold to their reserves in 2023, the highest level in decades. Norway's sovereign wealth fund, one of the world's largest and most sophisticated, has systematically reduced government bond holdings while increasing commodity and real asset exposure. Singapore's GIC and Temasek, among the most respected sovereign investors globally, have shifted billions from government bonds into infrastructure, real estate, and tangible assets. These aren't retail investors making emotional decisions. These are the most informed, most sophisticated institutions in the world, managing trillions in assets, and they're voting with their capital. The Bank of Japan, after decades of insisting it would maintain yield curve control, abandoned the policy in 2024 when the mathematics became impossible. They chose to let bond prices fall rather than continue unlimited money printing. The European Central Bank has quietly begun discussing how to manage sovereign debt restructuring as Italian and French debt burdens become unsustainable. These aren't theoretical concerns being debated in academic papers. These are practical problems forcing the world's largest central banks to confront the limits of their monetary manipulation. When the most powerful financial institutions in the world are repositioning away from government bonds, perhaps individual investors should pay attention. That's why this channel exists. Not to create fear, but to observe signals before they become obvious. To understand incentives and behaviors before they manifest in losses you cannot recover from. To provide the context that traditional financial media either doesn't understand or won't communicate because it conflicts with their advertisers' interests. We observe carefully what major institutions do, not what they say. We study history to recognize patterns that repeat across different times and places. We explain complex mechanisms in simple terms so that ordinary Americans can make informed decisions about their life savings. If this analysis makes sense to you, if it helps you understand what's actually happening beneath the surface of official pronouncements and mainstream financial advice, then subscribe to this channel. More importantly, take action. Not impulsive action, but thoughtful, measured repositioning based on understanding rather than hope. The greatest risk isn't the volatility of gold or commodities. The greatest risk is the comfortable illusion that government promises will be kept in real terms rather than nominal terms. Your retirement security depends on understanding the difference. The wealth you've accumulated over decades of work represents more than numbers on a statement. It represents freedom, security, dignity, and the ability to support family and enjoy the fruits of your labor. Protecting that wealth requires recognizing when the rules change, when assets that provided safety in one monetary environment become dangerous in another. We're living through such a change right now. Those who recognize it early and position accordingly will preserve and grow their purchasing power. Those who cling to conventional wisdom designed for a different era will suffer losses they cannot afford and cannot recover from in the time they have remaining. The choice, as always, is yours.